Every trading strategy works until it doesn't. How many times have you had a winning strategy, gone on a string of winning trades, and then all of a sudden the strategy that worked really, really well last month stops to work? It doesn't matter whether you're trading manually or algorithmically. In this video, I'm going to tell you the key to my trading success, and that is to trade like a hedge fund. And no, I don't know hedge fund strategies. I don't know how they trade, but I apply a very common concept in my trading, which not many retail traders utilize, and that is diversification. When you speak to a lot of traders, they tend to have their strategy, whether it's manual or algorithmic, and they'll focus on that strategy, maybe a variation of that strategy, and on a couple of assets. And ultimately, markets are cyclical. And what I mean by that is volumes change, markets change, trends change. Depending on the asset, whether it's trending or choppy, they change. So, a perfect example is the space that I'm in. A lot of people trade using algorithms, a singular algorithm on a common asset like gold, and it's a trend based algorithm. What happens when the market decides to chop? What happens then? You hear of so many people who get chopped out. They had great gains for 12 months using their martingale or grid strategy, and all of a sudden the market decides to chop or decides to revert to the mean and their trend based algorithm, and it chops up. And basically, that's where the concept of everything works until it doesn't comes from. So, the key for me, anyway, and my breakthrough was first and foremost to stop trading manually. But this discussion is not about trading manually. This discussion is about diversification. And I think diversification is actually hard to do when you're trading manually because there's too much stuff to focus on. So, what I tend to do when I diversify is have lots of different asset classes. That's first. Make sure they're uncorrelated, which I'll get into in a second. The second thing I do is to be on both sides of the market. So, for every single strategy that I create, and for those of you who don't know, I'm an algorithmic trader. For every single strategy that I create, I always have a long and I have a short strategy. What happens sometimes is if I'm in a day trade position, for example, I could be triggered into a long position, let's say on the German DAX, and the day's a sell off. So I might lose 0.3% of the sell off, and I might gain 0.6% on the short side because I'm on both sides of the market. So that's one way to diversify, is to have a long and a short for every single strategy that you're trading to hedge yourself. And it's not the same as hedging because you're not taking the positions at the exact same time with predetermined profit targets and stop losses. You're triggered into positions by the logic of your criteria of your algorithm. And a second way I trade is to use the concept of diversification. Hedge funds don't just buy Apple and Tesla. They'll buy thousands of companies sometimes to diversify their risk. And that was my big breakthrough in trading, was to completely diversify. In the past, I had all my eggs in one basket, and it's great when it's going well. Your win rate's high, your risk to reward is great. But then what happens? The markets change because, again, markets are cyclical. Volumes change depending on what time of the year you're in, depending on what the big money movers are doing. So things change. So when I say a diversified portfolio, generally my trading portfolio consists of some currency, some commodity, and some indexes. And again, I'm long and short for each of them. So one way to actually figure out what strategies work well together, because if you have 20 different strategies, you want to make sure that they're not all opening the same time because there's too much exposure. So you can run things like correlation tests and correlation matrices to see historically when all these positions got opened at the same time or not, and how to actually risk adjust for that scenario. Another thing which I like to do when it comes to diversifying in trading is something that's not really talked about too much, and that is trading what's in focus. So many traders, they learn a strategy on an asset and they don't deviate from that. They're hyper focused, which is great if you're a really, really good manual trader, but let's be honest, about 2% of traders are. So trade what's in focus. It'll give you a much easier time. Trade where the money is. What's in focus at the time right now, we're recording this video, is US equities. The volume's there, and you're going to have a lot of an easier time, in my opinion, to trade what's in focus rather than something that isn't in focus, where the markets could be choppy. Your setups may not always be like they are. So trade what's in focus. You'll have a much easier time. So coming back to wrapping it all together, I'm able to diversify completely, be on both sides of the market and trade what's in focus is using algorithmic trading. And at any one time with my trading portfolio, I'll have about 10 assets and I'll be long and short on most assets. So that's about 20 different strategies running at once. Now, if you are a manual trader, to sit there and to try to monitor 20 strategies, staring at charts all day, is almost impossible. One is enough. And that's even difficult. So when you use a systematic based approach to trading, and when you have diversification across all different types of assets in different directions, that's, in my opinion, where you can have more consistency in the market because you're diversified. You go into any big money management firm, you go into any big trading floor, they're not just focused on one thing, but the majority of the retail sector are focused on trading one asset. And you're going to have a very difficult time when you're just focusing on one asset. So consider spreading yourself across multiple assets, different directions. And again, when you do this algorithmically, when you remove yourself from the equation, when you remove human error from the equation, that's when you're going to have a much easier time of things. If you want to know more about how I do this, is the link in the description. So diversify is key. You read any books about successful people, about Peter Lynch on Wall Street, about Ray Dalio, hedge fund manager, they all talk about diversification. So diversify.